Common size statements, just be aware two approaches to do this. Either you show every item in the income statement as a percentage of your net sales figure, okay, or alternatively, we show each inflow in the cash flow statement as a percentage of total inflows, each outflow as a percentage of total outflows. Okay, now looking at each item as a percentage of net sales, our sales figure, useful for notice forecasting future cash flows, providing that these percentages are relatively stable over time. So if your CFO is a relatively fixed percentage of sales over time, let's say it fluctuates close to 25% of sales over time, then of course by forecasting next year's sales I could have a good stab at forecasting CFO. Now of course if these percentages are fluctuating heavily over time, then using this to forecast future cash flow from operations is going to be less useful. Looking at each inflow as a percentage of total inflows and each outflow as a percentage of total outflows, much more useful for looking at trend analysis, looking at the company and looking at how each inflow grows or reduces as a percentage of total inflows over time, and the same with outflows. Let's have a look at free cash flow. It's going to be a massive topic at level 2 when we look at equity valuation. Free cash flow is a method used to value either firms or majority holdings of equity. So free cash flow is the cash available for discretionary uses. Okay, so it could be distributed to the providers of finance. Now, discretionary uses, is capital expenditure discretionary or not? Some analysts say, well, only the capital expenditure required to replace the depreciation of existing assets is non-discretionary, and any capex for growth is discretionary. That's not the way the CFA view it. All capex is deemed to be non-discretionary in our exam. So therefore, our free cash flows are after all capital expenditure. Right, so it's used to value firms. It's going to reflect control. And there's two measures we look at: free cash flow to the firm and free cash flow to equity. Free cash flow to the firm is free cash flows available to distribute to both debt and equity holders. Key point, therefore, it's before any payments or receipts to the debt or equity holders. So notice we take net income plus non-cash charges minus working capital investment. Well, of course, that is cash flow from operations. Okay. Now, CFO is after interest payments, so we're going to add back interest net of tax. Okay, because we want cash flow from operations prior to distributions, prior to interest payments to the debt holders. Now, the idea here is if you're looking at it prior to the interest paid to debt holders, it's only fair that you lose the tax shield, similar to the argument that we made when we were looking at earnings per share. And then we're going to subtract fixed capital investment. Notice free cash flow to equity. Free cash flow to equity is often referred to as being a post-levered measure. So free cash flow to the firm is pre-levered because it's before any distributions to debt or equity holders. So it's before distributions to debt holders, therefore it's pre-levered, before we consider leverage. Free cash flow to equity is after payments and receipts to the debt holders, and therefore it is a post-levered figure. So what we're going to do is take our CFO. No need to add back interest here because we want the cash flow available to distribute after payments to debt holders. So we just take CFO, we subtract fixed capital investment, but then we add the net debt increase in the balance sheet, the change in balance sheet debt. Okay, we're going to add that. Well, let's have a go at doing this for Ruby Dog Toys. Assuming Ruby Dog Toys AG has a marginal tax rate of 35%, compute FCFF and FCFE. Okay, so our CFO, we've calculated that a million times now, 98,000. The cash interest value, notice it's the cash interest value rather than the interest expense in the income statement. The cash paid figure, that was 1,000. Multiply that by 1 minus your tax rate of 35%. And then subtract fixed capital investment, 15,000, and we get a free cash flow to the firm, 83,650 euros. Well, the analyst will then forecast that in the future and use the WACC, typically the weighted average cost of capital, a discount rate that reflects the required returns of both debt and equity holders, to discount future free cash flow to the firm to get firm value, sometimes referred to as enterprise value, the combined value of both debt and equity. Now, let's have a look at free cash flow to equity. So again, we're taking CFO, 98,000. We're subtracting the fixed capital investment again, 15,000. But this time adding on the increase in debt of 10,000, okay, to get 93,000. Now, if you're going to project this into the future and then discount it, okay, you would use the cost of equity, because these cash flows, the 93,000, is the cash available to distribute to equity holders. The free cash flow to the firm, the 83,650, is available to distribute to both debt and equity holders. Now, notice the difference between free cash flow to the firm and free cash flow to equity. The only difference is with free cash flow to the firm, we add back net interest, and with free cash flow to equity, we add any net debt increase, subtract any net debt decrease. So it makes it very easy to essentially reconcile from free cash flow to the firm to free cash flow to equity. So free cash flow to the firm, we calculated there at 83,650. Okay, there it is. We had added net interest, so subtract net interest. Okay, we're going to subtract it. 1,000 times our 1 minus tax rate. Okay, and of course, with free cash flow to equity, we need to add the net debt increase. So add the 10,000, and notice that takes us to free cash flow to the firm of 93,000. In other words, the only difference between free cash flow to the firm and free cash flow to equity are the payments and receipts to the debt holders. Okay. Couple of slides to finish off on, and that's really looking at cash flow statement based ratios. Look at cash flow to revenue. It's a cash-based measure of the net profit margin. When we look at net profit margin, of course, we look at net income over sales. All we are doing, okay, is replacing net income on our numerator with cash flow from operations. So a cash-based measure of the net profit margin. Cash return on assets, well, our return on assets is net income over average total assets. And it looks at how we're using the asset base to generate earnings. Well, all we're doing again is replacing earnings with CFO, so it's looking at how we use our asset base to generate operating cash flows to the company. Cash return on equity, this is the cash-based version of ROE. So if this was ROA, this is the cash-based version of ROE, which is net income over average stockholders' equity. Okay. So again, what we're doing is replacing CFO, replacing net income with CFO to get a cash-based measure. How are we using the funds that the investors have got tied up in the business, the equity in the business, the stockholders' funds in the business, to generate operating cash flows? Cash to income. So we're going to look at CFO over operating income. Well, again, there is no precise definition of operating income, so often we use EBIT as a proxy. So really what we're going to do is look at CFO over EBIT. And the key thing is we don't want EBIT to be greater than CFO. In other words, we want this ratio to be greater than 1, because if it is, it tells us our operating income is cash-based. It's backed by cash, and therefore the earnings quality is higher. Cash flow per share, notice it's the same as, remember we looked at earnings per share computations. All we've done is replace net income with CFO. A few other little ratios here. Debt coverage, CFO over total debt, where total debt is all interest-bearing liabilities. So this gives you an idea, really, of the proportion of debt you could pay down if you were to direct all your CFO to paying off principal. What proportion of our debt could we pay off? Interest coverage, well, of course, the interest coverage ratio, EBIT over interest, and we talked about that when we were looking at capitalization versus expensing. Again, notice what we're doing is saying, well, rather than looking at earnings before interest and tax, let's look at cash flow from operations before interest and tax. So we're taking our CFO and adding back interest and tax to get, if you like, a cash-based version of EBIT, and then we're putting that over our interest paid. Okay, so it's a safety ratio. Reinvestment, CFO, compared to cash paid for long-term assets, so capital expenditure in other words. Again, we want this ratio to be greater than 1. We want to make sure that we can afford our capital expenditure from the cash that the company raises from its day-to-day business operations. Because if we can't, then we're going to obviously have to raise more debt. Debt payment, CFO, over cash paid for long-term debt repayment. So we're looking, remember, at principal here, not interest. We're looking at the principal paid on debt, comparing it to CFO and asking ourselves, was CFO sufficient to pay off this year's principal? Because if it isn't, then either we're going to have to raise more debt to pay off existing debt, or we're going to have to, of course, dispose of assets. Dividend payment, well, one classic ratio we look at sometimes is net income over dividend. It's a safety ratio. We want net income to be higher than the dividend. It's looking at, it's the idea that you pay your dividends out of your net income. Well, reality is when we actually come to pay the dividend, we don't pay it out of earnings at all. We pay it out of cash flow. So let's look at CFO compared to the dividends paid to establish how safe our dividend stream is. How easy is it to maintain? And then finally, CFO over CFI plus CFF. Is our cash flow from operations big enough to support both investing and financing activities? Fabulous. That is the masterclass on the cash flow statement. It's a tricky area. Good luck with studying this. Plenty of questions. And remember, if you've got questions on it, then please interact with me in the Schw forums. Okay, I'll see you in the next masterclass.